So I was doing a lot of practice and a lot of stuff with appraisals I was not understanding.
Okay.
And
Yeah, that's easy for me. Yeah.
and what else did I send you? One other thing.
Oh, let me double check and see.
Forgot. There was one other thing that I was struggling with.
Get to my email. I got search. Looks like it's been one of those days.
Yeah.
Let's work on appraisals and mortgages. So yeah, so let's do appraisals because there's some stuff that we could actually probably kind of fit in from there with that have to do with mortgages and things like that. So let's look at valuation and market analysis. So you know the drill. Let's take a look at this one.
All right. An increase in the appraised value of property, which is considered unearned increment, would most probably result from. Okay. Unearned increment. This is a good start because I honestly, an increase in appraised value. I don't know. I'm taking a guess in this one. I would say capital improvements.
Increase in population. So let's talk about what unearned means, right?
Mm-hmm.
An increase in the appraised value of a property, which is considered an unearned increment, would most likely result from. So unearned basically means that you did nothing to get this. Okay? So when we're looking at capital improvements, you did something to earn that increment, that increase in the appraised value. So if I took a property and I added new kitchen, new amenities, those would be capital improvements. There would be, and if there was an increase in the appraised value, we would consider that an earned increment, right? Because I did something to affect that. When it comes to unearned, there's usually things that have nothing to do with one another that have, that are occurring that have a somewhat of an impact on, the value, but have not been by anything that you have caused. So the only one in there that would make sense would be the increase in population, because right now we're actually probably going to see that with people moving from more highly densely populated areas. If they're, if you're living in Manhattan and your job just told you, hey, hey, you don't need to work in Wall Street. You can work from home. Like, are those people going to be moving out to the suburbs, or are they going to be, there's going to be an increase in population, and usually that would have an impact on that appraised value of a home, right? Gotcha. Does that make sense?
Yep, completely.
All right, perfect. Let's look at the next one.
An appraiser is assigned to appraise a house in an area with very few sales over the past year. One of the comparable properties she chooses is a home similar to the subject property. The house recently sold as a foreclosure property. When writing her appraisal report, what action will the appraiser take as a result of the foreclosed sale? Make a negative adjustment to the value of the subject property. Make a positive adjustment to the sales of the price of the foreclosed home. Make a negative adjustment to the sales of the foreclosed home. Make a positive adjustment to the value of the subject property. Okay. So a foreclosure home is they're defaulted on their payments. So an appraiser is assigned to appraise a house in an area with very few sales. One of the comparable. So my question, like when I was looking at houses, just in general, isn't a foreclosure house, the bank takes it, so the price might look lower, but in the end, the bank just wants to get rid of it?
potentially.
So wouldn't that, wouldn't it be a negative adjustment to the sales price because you can't really take a price that from a foreclosed home because they're just trying to get rid of it?
So you say make a negative adjustment to the sales price of the foreclosed home?
Yeah. Well, we forgot that.
Here's the thing. You're correct in your thought process, but you're not correct in the adjustment that you would make. So you said, aren't they looking to just sell it quick? Yes.
Mm-hmm.
So doesn't that mean that it sells for lower than what a regular house would sell for?
Correct.
So if I'm trying to look at a house and I said, oh, here's this foreclosed home, and I'm saying, hey, it sold for less than what I think this other one would sell for, then what do I need to do to the adjustments?
Oh, okay.
So you see what happened was this. Thought process was correct. How it came out, incorrect. You know what I'm saying?
Yeah. So basically, a home, like it says here, it would have to be a positive adjustment because the sales price is going to be a lower price than most other houses are going to sell for.
So what happens is, let's talk about the sales comparison approach for a little bit, because that's really what they're talking about here. They're talking about the sales comparison approach. Whenever we have the sales comparison approach, what we have is this. We have, whatchamacallit, we have the subject. And what's the subject property? Let me ask you that.
The foreclosed house.
No, the subject property, whenever you refer to a subject property, that is always going to be the house that we don't know the price for.
Okay.
So when I say to you, we have the subject and comparables, what happens is this. The subject is the one that we don't know the price for. So in the sales comparison or market data approach, we are always going to adjust the price of the comparables because those have been sold homes that we know the price for. And that's what we're comparing to the subject. So we always compare, would this have sold for more or less than the subject?
Mm-hmm.
And that's how we make our adjustments. Does that make sense?
Yeah.
All right. And you never adjust the subject because you don't know the price of the subject. So you'll have questions like that on the test. You never adjust the subject. Never. Because you don't know it. You're solving for it. That's the problem you're solving for. Right? So, next one.
Okay. Ms. Frankel, an appraiser, is appraising a single-family residence for which she has located 6 closely comparable properties, all sold within the past 6 months. The subject property is rented for $1,500 per month. It is a custom-built home, approximately 3 years old. Ms. Frankel would probably give the most weight in her final estimate of value to which of the following appraisal methods: gross rent multiplier, income approach, market data approach, and cost approach. Okay. So I'm thinking it's, hold on. Market data approach.
Let's see. Market data approach.
Oh.
Yeah. So I think that you're surprised about that. So let's just kind of go through it a little bit, okay? So Mrs. Frankel, an appraiser, is appraising a single-family residence for which she has located 6 closely comparable homes. The subject is rented for $1,500 a month. It is a custom-built home, approximately 3 years old. Ms. Frankel will probably give the most weight in the final estimate of value to which of the following appraisal methods. Whenever it's a residential home, and there are comparables, so listen to what I'm going to tell you. If there were no comparables available, okay, if it said there are no comparables to be found anywhere, then what happens is then they might use a cost approach, okay, or an income approach in this one. However, since there are comparables, whenever there's comparables, always go with the market data approach. Next one.
So that was easy.
That was super simple. Yeah.
Which of the following basic economic characteristics is the best expression of why real estate has value? Better prospects of speculative gain, the maximum utilization of available resources, the high cost of replacement, and nearest high rent areas. Is it B? Yeah, that wasn't easy.
Yeah. Which of the following basic economic characteristics is the best expression of why real estate has value? You know, that's it. Yeah, 100%.
All right. When appraising a commercial property, the appraiser is most concerned with the income generated by the property, accrued depreciation of the property, total debt service of the property, sales price of comparable properties. So, okay.
A, we said?
Yeah.
Yeah, income generated with the property. So that's, when we're talking about the income approach, that is always going to be the situation. We're looking at the income.
Using which of the following would require the value of land to be calculated separately from the value of improvements? The sales comparison approach, the cost approach, the gross rent multiplier, or the income capitalization approach? So this one is land, and would this one be the cost approach?
Would this one be the cost approach? Let's see. The cost approach. Okay. So what happens is this. Now, how do we come up with the value of land? Let me ask you that. I think that's an important thing to understand.
That I don't know.
Okay, we always come up with the value of land using the sales comparison approach. Reason why is because of this. We cannot use neither the income or the cost approach because it doesn't cost, you cannot create land. Right? You cannot build land, okay? And also, does land depreciate?
No.
Okay, we never depreciate land, okay? Because what happens is this. What are the three types of depreciation? Let me ask you that.
But physical, economic.
Okay.
And that's all I know.
Okay, so there's physical deterioration, right, which is the physical wear and tear.
Right.
Then there is the functional obsolescence, which that one was the one you were missing. So what happens is it's never going to be functionally obsolete because functional obsolescence has to do with, hey, is it a 4-bedroom home with, 1 bath? That has a functional obsolescence. Land will never be functionally obsolete, okay? And then the last one is economic obsolescence. And what happens is it could potentially experience economic obsolescence, but what happens is we never apply depreciation to land. So the situation here is that it will never, ever, the land will never experience any kind of economic obsolescence. Gotcha. It would be, because here's the thing. What happens is this, the structures on it experience economic obsolescence. Well, let me show you something. You ready? So I'm going to take a piece of land and I'll explain to you why it'll never experience economic obsolescence, okay? I take a piece of land. It has nothing on it. And what happens is houses around it are experiencing, okay, economic obsolescence because there's a new airport that was built down the road, okay? There's a new airport that was built down the road. So one would think, well, that land will also experience economic obsolescence. well, what if I told you I just built, I'm going to build a new airplane mechanics department on that piece of land. Now, all of a sudden, doesn't experience economic obsolescence, does it?
No.
Exactly. So buildings, structures, improvements to the land, they experience economic obsolescence, functional obsolescence, physical deterioration, that wear and tear. But economic obsolescence, they won't experience because you cannot make land economically obsolete, okay? Because you could always put on it something that would be akin to what should be, like a plus for what is creating economic obsolescence elsewhere. So let's look at the next one.
Which of the following is not a proper charge in determining net income for capitalization purposes? Maintenance expenses, vacancy and collection losses, mortgage interest, and management agent fees. I honestly have no clue on this one. But I'm going to guess on this one.
Okay.
I'm going to guess B on this one.
B. Let's see. Mortgage interest. So here's what it is. It's saying which of the following is not a proper charge in determining the net income for capitalization purposes. Okay. So the one that will not be used in determining net income, okay, is vacancy collection and vacancy and collection losses. Okay. Maintenance expenses, mortgage interest, and management fees would all go into determining the net income, because what happens is vacancy and collection losses just simply would not. And that's just one of those things that I hate to say it, but it's just like you just have to know it, So let's see the next one.
The general term value means a good buy, the average use and function of an object to all people, the function of an object, the worth, usefulness, or utility of an object to someone. It's D.
Okay, D. Let's see. Yep. So that is 100% the right answer there. Let's keep going.
Economic obsolescence in a property is generally a type of depreciation that is incurable due to architectural fault or result of poor maintenance caused by aging process. A.
Okay, A. Economic obsolescence is typically one that is not curable. So let me ask you this. What does it mean by curable and incurable?
Well, if we have something that's curable, like a disease, that means there's something that it's curable. If it's incurable, it means it can't go away.
Okay, so let me kind of help you out with curable and incurable. Okay. Typically, when we're talking about external obsolescence, they can't be cured. Okay. Because they're outside of the realm of your property. Okay.
Mm-hmm.
So when we're talking about like internal stuff, like functional obsolescence or physical deterioration, we refer to them as curable and incurable because of these two factors. There's a couple things. First, it's curable if the cost to cure it, okay, cost to cure, is less than the value it will bring. Okay, so let's say something cost me $500 to fix, but the value that it would bring to the property is going to be $2,000.
Right.
We would refer to that as a curable obsolescence, a curable functional obsolescence, a curable physical deterioration. Okay.
Mm-hmm.
When it's something that would be far greater cost than what it would bring as far as value, like typically foundation issues, problems with the property and all that kind of stuff, that would be referred to as basically a situation that is, again, not curable. They would be incurable in that sense. Does that make sense?
Mm-hmm.
Okay, let's go to the next one.
An appraiser asked to estimate the value of existing shopping center would probably give the most weight to which approach in the value. Cost approach, income approach, sales comparison approach, or gross rent multiplier approach. Income approach.
Income approach. Yeah, 100%.
So
Absolutely.
I wrote down from the previous question, commercial property equals income generated property. So this was a shopping center, which is a commercial property. So that's how I got income approach.
Bingo. Yeah, it's something that I'll tell you it's a good way to think about it. And, I think that when it comes to appraisals, it's just a matter of hearing these things through repetition and having this just conversational, okay, this is what this is. Okay, this is what that is, and just kind of identifying it. Because what happens with, especially in appraisals, I find at least, is that it's super repetitive. Like everything is super duper repetitive. Okay.
Right. So is this one repetitive also? This is a public library. Would that be income approach also? Because it's but that's different. You're saying it's cost approach.
So watch this. So this is one that it is repetitive. However, let's talk about what's repetitive about this. So here's the thing. Public library, last I checked, is not a wellspring of income.
Right.
So it's something that, here's what happens. They refer to those as public buildings, similar to like a church or a firehouse or a police station, okay? All of those things, okay? All of those things are going to be situations that, bottom line is this. They're going to all be situations that, bottom line is, they're going to be used with the cost approach because there is no income. They're not getting a rental income, right? Okay. So if they're not getting a rental income of any sort, then what happens in those situations is it would be inappropriate to use the income approach. Okay. It would be inappropriate to use the income approach. All right. Does that make sense? Okay.
So what's a hospital then?
Cost approach. Approach, because I would still use the cost approach because unless it's being treated as commercial space, there's a lot of, because with medical buildings, there are a lot of grants, there are a lot of public funding that goes into it. There's a lot of things that go into it, although yes, it is a business. Right. And yes, they might be renting certain buildings. Certain buildings might be dedicated. Like it's broad stroke of a pen. If I had to say, I would say cost approach. Could there be circumstances where, let's say we're in Podunk, Iowa, and it's like one building, and it's being rented by, Mr. Farmer Bob. Like I could argue that.
Gotcha.
Like I could see how the income approach would be appropriate, but where we are, there's a lot of nuances, and typically we're talking broad stroke of a pen. That would be the cost approach. Okay. So let's go to the next one.
An expensive home that later became surrounded by cheaper homes would suffer a loss in property value attributed to residential obsolescence, physical deterioration, economic obsolescence, or functional obsolescence. Well, I know it's one of the last two. It would be, hold on, an expensive home that later became surrounded by cheaper homes would suffer. It's going to be D.
D as in dog or B as in boy?
Dog.
Yep,
I knew it was between. Yep.
So here's the thing. Whenever we're talking about functional obsolescence, it's the functionality of the home itself. I have a home built in the 70s that has very, very small closets. Okay, my wife reminds me every day. We have such small garbage closets. Because, again, the home was never built with, we need full walk-in closets. Just that would be an example of functional obsolescence. If there's an externality, okay, like cheaper homes or even more expensive homes being built around the home, that is an external or economic obsolescence. It's that kind of depreciation.
Gotcha.
Does that make sense?
Yeah, 100%.
Okay. So, next one.
An appraiser is appraising a single-family residence noticed as an abandoned gas station next door. The appraiser would logically recommend which of the following: rezoning of the property, a structural pest control, a toxic waste report by the EPA, a soil report by the civil engineer. I mean, so I'm thinking it's between C and D, just like last one. And then I think it was going to be C.
C. Okay. Let's take a look and see if that is the answer. Yeah, 100%. 100%. Okay. So that is the situation there. Okay. And it's also going to be a form of economic obsolescence. Make sense?
Mm-hmm.
All right. Let's look at the next one.
Dirk Smith built an incredible mansion in the valley soon after. Many of his peers built trashy, tasteless properties right next to his that were clearly substandard. These properties clearly hurt the value of Dirk's property. This would be considered principle of regression, principle of contribution, principle of supply and demand, and principle of progression. Who writes these questions using trashy and it's funny and tasteless?
Yeah. Yeah. Well, you know what happens is these are all taken from various different sources. So it's one of those situations that, yeah. And here's the thing too, like, just so you know, depending on the test writer who writes the question, yeah, you could totally see something like that.
Yeah. A.
Okay. Let's see. A. The principle of regression. So talk to me about the principle of contribution. What is the principle of contribution?
That one I do not know.
Okay, so the principle of contribution is whenever you add something to a property, and it adds value to it. So watch this. I'll give you a perfect example. I bought a hot tub the other day, okay?
Right.
And the hot tub that I bought is simply replacing a hot tub that was existing. So what happened was when I bought that hot tub, it didn't contribute to the property. There was nothing that it contributed, okay?
Right.
Now, if the hot tub was never there, and I went to get permits and I did all that, and I, then added a hot tub to my property, if that contributed value to the property that was more than $1, then yes, that is the principle of contribution at work. Does that make sense?
Mm-hmm.
Okay. Next one.
Which of the following be classified as external depreciation? A leaking roof that needs to be completely replaced, a poorly designed floor plan that can be modified, a poorly maintained properties in neighborhood, convenient access to schools and recreational facilities. C.
Okay, C.
Outside control.
So now let me ask you this. Do you want to go to financing? You want to switch gears?
Sure.
All right, cool. Because I think that we hit on cost approach, market data approach, income approach. So we hit on almost everything, which I liked. And that's why I like doing it this way.
Right.
So, and we also talked about depreciation. We talked about curable, incurable.
Mm-hmm.
We went over all those kinds of things. So let's look at financing. Let's do that.
If buyer wants to take out an FHA loan, brokers should refer to the buyer directly to an approved lending institution such as a bank or savings and loan association, an FHA appraiser in the area, the Federal National Mortgage Association, the Federal Housing Administration Office.
Let's
A.
see. So
That makes sense.
yeah. So tell me what an FHA loan is. Can you tell me what that is?
That's a loan for not positive. That one.
Okay. So what it is this. An FHA loan, okay? An FHA loan is going to be a loan that will, whatchamacallit, basically allow for a lower down payment, like a much lower down payment. So people usually get that when they, you know, have like under 10% to put down. Also, if they're credit challenged, okay, meaning they can't probably qualify for a conventional loan, okay, they would go and get an FHA loan. And what's the difference between an FHA and conventional loan other than those things? Like what is the, why do they allow for this to, whatchamacallit, for this to be, you know, such a low down payment, and they allow people who are credit challenged to take out this loan? Why is that?
Not with the Truth in Lending Act, where
Nope. Doesn't have to do with truth in lending. Nope.
I don't know.
Okay. What it has to do with is this. It's a government insured loan. It's insured by it's insured by the FHA. The FHA insures it. So because the FHA insures it and they insure the lender, okay, they basically are like, yeah, sure, we'll take these credit challenged people. Sure, they don't have to do, you know, they don't have to, you know, they don't have to, you know, put all this money down. So it's like, it's basically, they're letting them take, you know, a loan out at a higher risk, you know, either with the down payment or that they're credit challenged. Does that make sense?
Mm-hmm.
All right. Let's look at the next one.
Wait, I can't see.
Yeah. Oh, let me move this. How about now?
Yeah. Which of the following best expresses the concept of equity? Current market value minus cost of land, replacement cost minus depreciation, current market value minus property debt, current market value minus capital gain.
Think about this. If you wanted to find out how much equity was in your home, what would you do?
You look at the current market value minus property debt.
So C?
Yeah.
All right. Yep, that's it. So you take whatever the current market value is. Like you want to say, how much equity do we have in the home? Okay, let's take a look. It's worth, you know, this much now. It's worth $400,000. We have $200,000 worth of debt. So the answer would be, whatchamacallit, you know, basically 200,000 in equity. So let's look at this one.
If a single parent is applying for a real estate loan, when would the fact have to be revealed that the part of the parent's income is from child support? When applying for a VA or FHA loan, if the parent's income is less than $25,000, the type of income never needs to be disclosed. It would be a violation of ECOA. If more than 50% of the parent's income is from non-wage sources, if the parent was relying on the income for repayment of the loan. D.
Yeah, if they're relying on it for the payment of the loan, right? So 100%. Because what happens is, what they look at is the debt to income ratio, right? They look at the debt to income ratio. So let's look at the next one.
Lender is not insured or guaranteed against a loss by reason of the borrower's default in repayment under which type of loan? Lender is not insured or guaranteed against a loss by reason of borrower's default in repayment under which type of loan? Is that a conventional loan?
Yeah, that's 100% a conventional loan, because FHA is insured, VA is guaranteed, and the GI Bill is same as a VA. It's an old type of loan. That's what they used to call the VA loan. So good job there.
So conventional is uninsured.
Basically, conventional is one that is not FHA insured or VA guaranteed. So there is no. That's why the requirements are a little stricter. Okay. That's why a conventional loan, it's like they're going to sit there and, dot their I's, cross their T's a little bit more. Does that make sense?
Mm-hmm. Pledging property as security for a loan without losing possession of it is called what? Purchase money mortgage, a subordination agreement, an impound account, or how do you say that one? Hypothecation?
Hypothecation.
Hypothecation. Yep. Impound account.
That's what you want to say?
Yeah. It's going to be D.
Yeah, try hypothecation.
Yep.
Try hypothecation. Now, so let's talk about what hypothecation means, okay? Because this is a good one, and this you're going to see in lending a lot. Like, you're going to see this when it comes to mortgages, okay? Mm-hmm. And the situation is this, okay? When it comes to mortgages, when someone mortgages a property, so they give the bank a mortgage on their home, they're actually pledging it as repayment for the loan. They're saying, here, you have this home as collateral for repayment of the mortgage. For repayment of the loan. Okay? So when I sit there and say, here, Mr. Bank, you can have a mortgage on my property, okay, I'm hypothecating it. I'm saying, okay, I'm pledging this home as repayment for the loan, okay? I'm pledging it as repayment for the loan. Mm-hmm. So, does that make sense?
Yeah.
All right. Let's look at the next one.
An FHA insured loan transaction. In an FHA insured loan transaction, the interest rate is set by the FHA. Mortgage interest premium may be paid by either the seller or the buyer. Discount points may be paid by either by the seller or the buyer. Mortgage insurance premium must be paid by the seller. See, if I was getting a house, I would understand these a lot more. So I don't think it's D.
You might not, because this one's a tough one. So which one do you think maybe if you tried to logic it out?
I think B. I don't think D because it says must, and when it says must, it's usually not the correct answer.
Okay, you say B as in boy?
Yeah.
I think it's C.
I had no clue.
So, mortgage, and I totally get that. So, what is mortgage insurance premium? Do you know what that is?
No.
Let me start with that. Okay. So, mortgage insurance premium is the same as PMI. Do you know what that is?
No.
Okay. So, let's talk about PMI. PMI is on conventional loans. If the loan to value amount on a on a conventional loan is greater than 80% to value, okay? So 82%, 90% loan to value amount on a conventional loan, what happens is this. The borrower must pay what is referred to as private mortgage insurance. Private mortgage insurance is paid annually and broken down to a monthly amount. And it's insurance for the lender, okay? Basically, you're insuring the lender. You're saying, hey, Mr. Lender, we're covering you against any kind of default or anything like that. Now, mortgage insurance premium is the same thing but for FHA loans, okay? And it works a little differently. So what happens is the mortgage insurance premium is something obviously is the responsibility of the buyer, okay? The borrower who's taking out the money, they're responsible for that mortgage insurance premium. They're responsible for making sure that the lender, okay, that the lender is going to be covered on this, because the lender is going to say, hey, if you're not putting down X amount, okay, then we want you to take out private, or actually, let me rephrase that. You have to take out private mortgage insurance. And for an FHA loan, it would be mortgage insurance premium. So they're going to say, hey, you have to pay this. And it's not a choice, and the buyer pays that. The borrower pays that. So what can happen, though, in a FHA transaction, also in conventional transactions too, is that discount points can be paid by the, can be paid by the buyer or the seller.
Right.
So let's say the borrower doesn't have, a lot of liquid money. And they're like, look, I can't afford, the 5 discount points, but I won't be able to afford the monthly payment if I don't discount it down with the 5 points. So, Mr. Seller, hey, we'll give you this offer. You're going to get this money, but could you pay for our discount points? Because we don't have it up front, So the seller could potentially pay the discount points. It's basically like a way of giving back some money to the borrower at closing. Like they could do that.
Gotcha.
So it could be paid by the buyer or the seller. So understand that if they ever say, and how much is a discount point? So if I'm talking about a point on a loan, how
1%.
much is that? Of what?
Of the discount, right? Isn't a discount point 1%?
So any point is 1% of what, though? 1% of what?
The loan.
Bingo. Yes, 1% of the loan. So 1 point, whenever they're talking about a point, whether it be a discount point, just points for originating, things like that, it's always 1% of the loan. Good.
This is A.
Really easy, right?
It says
So
installment.
let's go to the next one.
Yeah.
That's an easy one.
When must a copy of the loan broker statement be given to the borrower? When signed at closing within 3 days, it is negotiable. Within 3 days.
So this is not the same as the loan estimate. The loan estimate is going to be, has to be given within 3 days of the loan application, okay? A loan broker statement, okay, has to be given when signed, okay? So any loan broker statement is not the same as giving you an exact breakdown of what the loan is going to cost, right? A loan estimate. That's done at time of application, and they still need time to calculate that and give you a loan estimate.
Right.
So that's why that is within 3 days of the application, because they have to make sure that you're approved, all that kind of stuff. But a loan broker statement, okay, it basically gives some detailed information, and this has to be given right as soon as it's signed, okay? Gotcha. This will be accompanying that, but the actual loan estimate, okay, like that finalized number is going to be within 3 days. That's where you're getting confused with that. So let's look at this one.
A clause in a loan document which makes the payments periodically increase is known as interest clause, alienation clause, acceleration clause, escalation clause. Acceleration clause.
Okay. You meant to say escalation clause, right?
No, I didn't. Well, that makes sense. That would make sense.
Yeah. So what is an acceleration clause? Let me ask you what an acceleration clause is.
It accelerates the payment, so you pay it off at a quicker amount of time.
No. Okay. Let me explain it, because actually what happens is an acceleration clause is used more as a punitive, and when I say punitive, I mean a penalizing fashion. So what happens is this: it is punitive in the fact that a acceleration clause, basically, if the borrower defaults on the loan, okay, so the borrower defaults, then what happens is the lender has the right to make the full amount due immediately. Like they can say, you owe us everything now, not waiting, no, thank you. That's an acceleration clause, okay? And an escalation clause basically makes the payments periodically increase, okay? And that is an escalation clause. So what you had as an example of acceleration clause was more closely related to escalation and what they were asking here. So let's go to the next one.
When obtaining a mortgage loan, the buyer often has to pay discount points. These points are percentages of what? The loan amount.
Okay.
We just did that.
See how it comes in handy though? So that's why,
Yeah.
I mean, I laugh, but like, it's, if you repeat it, you say it, you go, hey, this is what it is.
Right.
Yep. It's super easy. And it's here's what I'll tell you. And I mean, this is going to sound like a really stupid statement,
Right.
but when you know something cold, it's so easy to answer the questions. And
Right.
that's what you're trying to do. You're trying to gain a knowledge of like, oh, I know what that is. Oh, I know exactly what that is. Like when I look at a question, that's why it's not that I memorize these questions at all. It's that I just sit there and I'm like, oh, I know what that is. I'm like, oh, I know what that is. Like, you know, so that's why it's like, I know probably 90% of these, and there's some that I'm like, you know, not so sure. So let's take a look at this one.
Which statement does not correctly describe mortgage fraud? The use of inflated appraisal in collusion with a lender. Mortgage fraud can be created through the use of false identity on a loan application without the true person's true person's knowledge. Mortgage fraud is punishable by 40 years in federal prison. Mortgage fraud is investigated by the FBI. I mean, okay. I think it's going to be A or D.
Okay.
So I'm not really sure. I mean, because if you read it all, I mean, you would think that, I don't even know.
So which statement does not correctly describe mortgage fraud?
I say C.
Okay.
No clue.
Yeah. Okay.
40 years just seems like a huge amount of time. Like murderers don't even get 40 years.
So what happens is this: they're generally handled at the state level and are less severe than 40 years. Yeah, that was pretty extreme. You know, it was pretty extreme for one type of felony like that. Typically, like just so you know, it's typically like somewhere in the 5 to 10 year range. You actually serve typically like 5 to 6. So that's typically what it is. It's usually in that range. So let's look at this one.
A balloon payment is usually associated with variable mortgage that varies with the cost of living index, package mortgage, blanket mortgage, large payment during the term or at the end of payment schedule. D.
D. Yeah, so like, let me give you a perfect example. Right now, with a lot of people putting forbearance on their mortgages, okay, all those things that they pushed off are basically going to become a balloon payment at the end of the loan.
Right.
That's basically what it is. So all the forbearance that people have been experiencing over the last several months, that is exactly what it is. So next one.
According to the Truth Lending Law, Regulation Z, the disclosure statement for a borrower must include the following: the APR, late payment charge, and the total dollar amount that will be paid over the loan. The APR, late payment charge, and total interest charge over life. APR, late and total amount of dollar finances. APR, D.
D. I think there's a more complete answer. A. So let's talk about why that is. It's basically disclosing everything, and that's the real answer there. You know, that's the real answer in regards to the question, is that it has to disclose every little bit of it. You know, nothing could be left out. Nothing at all could be left out. So let's look at the next one.
The Real Estate Settlement Procedures Act applies to which of the following activities? Licensed lenders when preparing home loans, title and escrow companies closing residential properties, title and escrow companies closing commercial properties, licensed broker when selling commercial properties. A.
Okay. Yeah. So that is 100% correct as far as RESPA. So let's look at this one. Ooh, this was a great one. I love this one.
B.
Okay. Yeah, so now here's what happens is, and you'll see questions like this, and I want to just clarify this. So a promissory note, also referred to as a note, okay, that basically outlines for you. It basically says, this is the evidence of my debt, right? So here is the evidence of my debt. Then what happens is this. Says this is the evidence of my debt, and to secure that, they give the lender a mortgage, okay? So what happens is this. Imagine I'm the bank, and I said, here's your $100,000, and then you said, here's my IOU, I'd be like, I don't really know you that well. Like, this IOU is kind of junky. And you're going to say, okay, you know what, to make that more secure, let me give you this mortgage, which is me hypothecating the real estate I'm buying with it as a pledge of real the pledge of, this is I'm hypothecating this as collateral for repayment of the loan, okay, securing the note. So it is said that the mortgage secures the note, okay, and they would use that language too. They'd say the mortgage secures the note. It adds more credence to it. It gives it a little more security. So next one.
When leasing commercial property that is merely a shell space, the landlord often agrees to spend a specific amount for qualified tenant. Amount is probably designed as security deposit, a tenant improvement allowance, a rent abatement, and an earnest money deposit.
It's pretty literal.
Yeah. Sorry, my son just started to cry.
No, it's okay. I totally get it.
He's in the crib, and out of nowhere, he just started to cry.
Trust me, I totally get it.
I'm thrown off. B.
Okay, a tenant improvement allowance. It's literally, yeah, it's super literal.
Tenant, yeah.
Yeah. So what happens is this: in a lot of commercial spaces, they do this. Like I had a tenant at the beginning of the year. I mean, a landlord at the beginning of the year. He had this big open commercial space, and he said, "Stu, should I do anything with it?" And I said to him, "No, just use that money as a tenant improvement allowance, right? That they could do something if they want to, I said, because why do something and then have them say to you, I don't really like the space the way you have it, So what happened was two of our tenants that we had that we were prospecting one was a martial arts studio. So they wanted it very open, right? They wanted minimal sheetrock. They wanted to just sheetrock it, floor it, done, okay? Another was a commercial real estate firm. And they wanted to have separate offices, doors, privacy, soundproofing, all that kind of stuff. So that was a completely different tenant. So depending on which one they went with, and they went with the martial arts studio, they wanted just pretty wide open. So they were just like, cover the frames, leave the ceiling, bare, and they basically put more of the allowance that they were going to put in to the flooring. They were like, oh, we'd like to have, really padded matting and stuff like that. So they were like, yeah, sure, So it worked out. So next one.
When comparing a straight note with an installment note, the straight note will have principal payment. Will have all the principal payments during the term of the loan, including the last payment. We'll have a total effective interest rate greater than the loan where an installment loan. If the loan were an installment, we'll have equal annual principal reduction. We'll have no principal payment during the loan except in the last payment. Straight note. I think it's D.
Okay, D. Let's take a look. Yeah. So
No principal.
a straight note. A straight note is basically interest only. So yeah, that was a great one. So let's keep going. See if we can get a couple more in.
In terms of some real estate loans, provide that the interest rate may be increased or decreased depending on the money market conditions. We call this type of loan a fluctuating market condition loan, a variable interest rate loan, a loan which is secured by short-term land contract, on an interim loan. It's going to be, I mean, I'm going with B, but it would be between B and D for me.
Okay, let's see. You want to go B?
Yeah.
Exactly what it is.
Yeah.
Okay.
Yeah.
When it says that the interest might increase or decrease, that's going to be an ARM or a variable interest rate loan. Okay, where it's going to vary. So let's wrap up with this one. Let's take a look at this one.
A clause in a trust deed or mortgage that permits the lender to declare the entire unpaid balance immediately due and payable upon default is. Is that a forfeiture clause?
What about an acceleration clause? Remember we talked about that? We said, hey, if they stop paying,
Oh yeah.
say, hey, the full amount is due. Yeah.
So this is a payment right away. Gotcha.
Yeah, payment right away, due upon the borrower's default. That's what an acceleration clause is. Now, question I have for you: is there any other questions that you might have?
No, I mean, I started like for appraisal. I'm definitely on after today. Definitely understood it a lot more, and I'll go through that one. Which section was that? So I can just do that section.
That's going to be a valuation, market analysis and valuation.
Okay.
So if you go to your prep agent account,
right?
Okay, and you go to your practice exams, you would go down to valuation and market analysis. Right. That would be the one that you'd be looking at. And then we ended on financing.
Yes.
Yeah.
Okay.
So I'm glad that you got a really good understanding of it. And actually I felt that we got a lot out of this because we went over a lot of different things in valuation and market analysis. We went over a lot of different things in financing. I actually wanted to ask you, would it be all right if I used this session that we just recorded in the future for anyone else who might be thinking about taking a private lesson or people who might get some benefit out of this? Because I sometimes post that on my YouTube channel. Perfect. Awesome. So other than that, anything else that you want to add or,
No, I think that's
over?
All. Yeah.
Hey, look, good luck, good luck with, the test. And if you need me, you know how to reach out. All right, buddy?
Okay. Thank you.
Hey, not a problem. Have a great one.